Bitcoin just had its most important event of the decade, the halving. And now everyone's asking the same question. Can Bitcoin hit $150,000 in 2025? Some analysts say yes, pointing to institutional money pouring in through ETFs. Others say no way, that the bull run has already peaked now that Bitcoin has already crossed $100,000. Here's the truth. Price doesn't move on hype alone. It moves because of supply shocks, macroeconomic forces, and real-world adoption. In this video, I'm going to break down the data, the history, and the risks so you'll know the probabilities, not just the prediction. And if you want clear, fact-checked Bitcoin analysis every week, not hype, not fear, make sure you subscribe. Let's dig in. Why Bitcoin even moves. Before we talk about $150,000 Bitcoin, let's dig a bit deeper into why Bitcoin behaves the way it does. It comes down to one principle: supply and demand. Bitcoin has a hard cap of 21 million coins. There will never be more. That's what makes it unique. Now, every 4 years, something called the halving takes place. That's when the number of new Bitcoins created gets cut in half. In April 2024, block reward went from 6.25 Bitcoin to just 3.125. Fewer new coins enter circulation, and historically, that's been the spark for massive bull runs. Think of it this way. Imagine the world's gold mines suddenly cut their output in half overnight. Gold would probably shoot up in price. That's what the halving does for Bitcoin. After the 2016 halving, it ran up more than 2,000%. After the 2020 halving, it exploded to nearly $70,000 per Bitcoin. Each cycle had diminishing returns, but the pattern is clear. Scarcity drives demand, and demand drives price. Now let's go deeper. Bitcoin mining difficulty adjusts automatically as more miners compete. That means it gets harder and more expensive to mine Bitcoin over time. This raises the break-even cost for miners, which often creates a price floor. Miner behavior also matters. Sometimes miners sell their coins immediately to cover electricity and hardware costs. Other times they hold. After the 2024 halving, with fewer coins to sell and rising costs, miners are actually more likely to hold, reducing supply pressure. And then there's volatility. Bitcoin is still young. That means smaller markets, high speculation, and fewer swings. Even a single piece of news, like an ETF approval or a regulatory crackdown, can send the price surging or even crashing. So while supply is predictable, demand is always shifting. That's what makes Bitcoin exciting, but also volatile. If this breakdown is helping, give this video a like. It tells YouTube that you want more in-depth Bitcoin analysis like this. Macro setup for 2025. Supply is only half the story. The other half, macroeconomics. In 2024, the Federal Reserve held interest rates at the highest levels in 2 decades. That made borrowing money more expensive, slowed down the economy, and hit risk assets, including Bitcoin. But as we moved into 2025, the tide began shifting. In September 2025, the Fed finally cut rates by 25 basis points, dropping the target range to 4 to 4.25%. That was the first cut since late 2024. And according to the Fed's own projections, the so-called dot plot, 2 more rate cuts are expected before the end of this year, bringing rates closer to 3.5 to 3.75% by December. Why does that matter to Bitcoin? Lower rates make borrowing cheaper, institutions and funds can access leverage more easily, and risk assets, Bitcoin, suddenly look more attractive than low-yield bonds or cash. Inflation is another big factor. Headline inflation has cooled since the 2022 peak. Core inflation, things like housing, food, and energy, remain sticky. When people see prices rising faster than wages, trust in the dollar erodes. What do they turn to? Alternatives like gold and increasingly Bitcoin. Now let's zoom out. The US national debt has passed $34 trillion. Servicing that debt gets harder as interest costs climb. Some analysts believe that this creates a debt spiral that weakens the dollar over time. That narrative fuels Bitcoin's appeal as digital hard money. And let's not forget about global forces. The BRICS nations, Brazil, Russia, India, China, South Africa have been talking about alternatives to the US dollar in trade. Moves like that amplify Bitcoin's story as a neutral and global currency. But here's the biggest driver for 2020: institutional money. When the SEC approved spot Bitcoin ETFs in January 2024, it unlocked a floodgate. BlackRock, Fidelity, ARK Invest all rolled out funds, and within months, billions poured in. BlackRock's ETF alone now manages over $20 billion worth of Bitcoin, more than most exchanges hold. And here's the key: when institutions buy Bitcoin, they usually hold it. That Bitcoin comes off the market, tightening supply even more. Combine that with halvings, and you see why some analysts believe that we are heading towards $150,000 Bitcoin. And by the way, if you want my full beginner's guide to buying Bitcoin safely, I'll link that video at the end of this one. Do not miss it. The halving aftershocks. So let's come back to the halving, because it's the foundation for a $150,000 Bitcoin prediction. Every halving reduces the number of new Bitcoins miners can sell. In April 2024, daily new supply dropped from about 900 Bitcoin per day to just 450. And at today's price of around $113,000, that's a reduction of more than $50 million in daily selling pressure. Compare that to ETF demand. Some days, ETFs are absorbing multiple times that daily supply. That's unprecedented. Historically, the big rallies come after a lag. In 2012, Bitcoin peaked a year after the halving. In 2016, it took about 12 to 18 months. In 2020, about a year again. If history rhymes, that puts the peak squarely in 2025. If you're already seeing how history is rhyming here, drop a comment. What's your Bitcoin top price prediction for 2025? 120K, 150K, or 200K plus? I'll be reading them all. On-chain data, psychology, and interest rate cuts. One of the best ways to cut through the noise is on-chain data, the blockchain itself telling us what's happening. Right now, long-term holders are stacking more. Coins that haven't moved in years are staying locked up. Exchange balances are trending down. That means fewer coins are sitting around waiting to be sold. That's a bullish signal. The MV/RV ratio, market value compared to realized value, shows how much profit the average coin holder has. High profits often mean tops are near, but right now it's elevated but not at bubble levels. There is room to run. Dormancy flow, another on-chain metric, tracks how long coins have been sitting still. Recently, dormancy has stayed low, meaning old coins aren't flooding back to the market. Historically, that's another bullish indicator. Sentiment matters too. The Bitcoin Fear and Greed Index, Google Trends, social chatter all show a shift. People are moving from fear into greed, and in early bull markets, that usually fuels rallies. So let's tie this to the macro backdrop: interest rate cuts. In September 2025, the Fed made its first rate cut in almost a year. They lowered the federal funds rate by 25 basis points, bringing it to 4 to 4.25%. And they've projected 2 more cuts before the end of the year. And that means by December, we could see rates in the mid 3% range. And why does that matter? Lower rates mean borrowing money is cheaper. Capital flows back into risk assets like stocks, tech, and yes, Bitcoin. Bonds become less attractive, cash yields less, investors start hunting for growth and upside. This isn't just theory, we saw it in 2020. When the Fed cut rates and injected liquidity during COVID, Bitcoin exploded from $4,000 to $69,000 in less than 2 years. Rate cuts fuel liquidity, and liquidity fuels Bitcoin. Of course, cuts aren't guaranteed. They depend on inflation staying under control and unemployment not spiking. If inflation flares up again, the Fed could pause or reverse. But for now, rate cuts are on the table and markets know it. So when you add shrinking supply from the halving, increasing institutional demand, and a friendlier macro environment with falling rates, you can see why $150,000 Bitcoin is right on our radar. If charts and macro breakdowns like this fascinate you, make sure you're subscribed. I cover on-chain data and macro every single week so you stay ahead of the herd. Institutional adoption. Institutions are the big new player in this cycle. MicroStrategy now holds about 580,000 Bitcoins, making it the largest corporate holder in history. Tesla still holds Bitcoins. Sovereign nations are experimenting too. Salvador continues to hold, and others are quietly watching. At the same time, central banks are rolling out CBDCs, central bank digital currency. While CBDCs are different from Bitcoin, they highlight a global shift. Money is going digital, and Bitcoin is the only decentralized, scarce, borderless digital asset. Want to see exactly how to set up your first Bitcoin wallet? I've got a full step-by-step tutorial video. I'll link it in the description and at the end screen. Prediction models. Now we get to the big question. Could Bitcoin hit $150,000 per coin in 2025? Let's look at the scenarios. The bear case. If liquidity dries up, regulation hits hard, and demand fizzles, Bitcoin might top out somewhere between $80,000 to $120,000. That would mean today's price is near the cycle's peak. In the base case, if ETF and institutional demand continues, macro conditions improve, and history repeats, Bitcoin can land between $140,000 and $180,000 per coin. In the bull case, everything aligned. ETF demand keeps crushing supply, global adoption expands, and macro tailwinds strengthen, we could see Bitcoin reaching $200,000 per coin or even more. Models like stock to flow point to six-figure prices. Plan B's updated outlook suggests that we're on track for a strong cycle, though not without volatility. Other analysts argue diminishing returns will limit the upside. Here's the key. No model is perfect, but when you layer in supply shock, institutional demand, and macro conditions, probabilities lean bullish. Risks and bearish case. So let's be clear, it's not all upside. There are real risks. Regulation. Governments could impose stricter rules on exchanges, wallets, or ETFs, and that could slow down adoption. Second is leverage. Crypto markets have a history of blowing up when traders borrow too much. A repeat of the 2021 liquidation cascades could send prices crashing temporarily. Third, macro shocks. A deep recession, liquidity crunch, or global conflict could hurt risk assets across the board. And fourth, expectations. If too many people believe that $150 Bitcoin is guaranteed, the market could disappoint, and sharp pullbacks are always part of the Bitcoin journey. And if you think Bitcoin could actually fall here, comment why. Healthy debate helps everyone sharpen their thinking. So, could Bitcoin hit $150,000 in 2025? The answer is yes, it's possible, but it's not guaranteed. The outcome depends on demand, adoption, and macro forces lining up. What history tells us is this: halving cycles create powerful tailwinds. Institutions are adding a whole new layer of demand, and the risks, while real, don't erase Bitcoin's unique position as scarce, global, and decentralized money. If you made it this far, you're serious about Bitcoin. Hit the like button, subscribe, and turn on notifications for weekly deep dives like this. And next, watch my video on dollar cost averaging Bitcoin, safest way to build wealth no matter what happens with price. I'll link it right here.